more minute just for the, I'm sure, the massive influx of people wanting to join this webinar. We'll be starting in 1 more minute. Hopefully everyone is well on the 30th of April. Can everyone believe it is May tomorrow? The one thing I need to remember tomorrow is to pinch and punch my kids. There's usually a race on who can pinch and punch each other on the first day of the month. So that's my one priority tomorrow.
And I guess they'll slap and kick you for being so quick.
They certainly will. What's the other one? No get back. There's another one.
Yeah.
Okay, cool. We might get started. It is 12:01. But thank you everyone for attending this webinar. So this is our second webinar for 2024. We are planning a few further webinars during the rest of the calendar year. And the main reason why we're doing these webinars is to add value as well as educate our clients, as well as the broader business community. This webinar is entitled Unlocking the 5 Strategies of Effective Tax Planning. A comment, it is being recorded, so everyone who has registered will receive a recording of this webinar, as well as there might be some questions at the end of this webinar. Tax planning is a major area of advice for us, as everyone usually wants to reduce their tax liability. The thing to know about reducing tax is there are some limitations, as well as there are specific rules around what you can and can't do. This presentation will discuss some strategies you can implement before the end of the financial year. But basically, we want our clients to succeed and to improve their business life. And that's why we've put these webinars. We advise over 350 client groups. So we want them to succeed. So sharing knowledge in any sort of aspect of business improvement is a no-brainer for us. Next slide, please. As usual, when anyone in the financial area or any sort of area does any sort of presentation, we've put together a disclaimer. So everything we're saying here in this presentation is general in nature and not to be considered personal advice. If you want advice specifically to you, please contact us. We're happy to help. Next slide, please. So here we've got the presenters today. One comment, Eliza is absent today. Unfortunately, she contacted COVID the other day, so her voice is pretty scratchy. So we thought it might be better for her to tap out or sub out. So she won't be presenting. So the remaining presenters is, first of all, Mark Deviljack. He's a director at Rubiix. He's an authorised representative of Rubiix Wealth. He's a fellow of a chartered accountants with over 35 years in the business and tax advice space, with over 25 years of owning and running a business. He's a keen skier, as well as a supporter of arts, and he's on the board of a couple not-for-profits. Marianne, she has a Bachelor of Commerce specialising in accounting and have completed a graduate diploma in chartered accounts as well. Not a fellow though, Marianne. She started working in the accounting industry in 2009 with over 10 years experience, has an extensive exposure to individuals, corporate entities in the various industries. What she enjoys is getting to know her clients, understanding the strategic objectives and providing tax advice associated around that. And also she finds satisfaction assisting and working with her colleagues and staff, which is great. And myself, I've got over 25 years experience in the business and tax space as well. 14 years owner of Rubiix with Mark, authorised rep of Rubiix Wealth as well as only a chartered accountant, so not a fellow, and hoping for an Essendon final win this year. Next slide. That's a little bit about us. The learning outcomes that we want from this presentation for everyone attending is, first of all, understanding the tax landscape, so navigating the complexities of the tax system and identifying opportunities for businesses. Being proactive and tax saving strategies, practical tips. So we'll run through some practical tips, strategies to minimise your tax liabilities as well as today, and remaining compliant with the ATO, which is the main thing that we want. Ensuring compliance, so best practice for fulfilling your super obligations, payroll tax, and meeting the normal requirements. Trust distributions we'll cover off on today, so guidance on managing trust distributions, and being proactive, so strategies about being proactive for tax planning and staying ahead of regulatory changes and optimising your tax position. So this presentation we have broken down in specific areas for business owners. So they may not be in that particular order, but we'll try to do it. So the main reason why we put together these presentations, or the main reason what we hear from business owners when they're talking about what they've saved from tax. So business owners say to us, this is what we've actually done with the cash that we've been able to save from reducing tax. So they've been able to save tax to reduce home loans, save tax to put more money into super, to save for that holiday, deposit for that investment property, paying for children's education or upgrading that car. So being proactive around minimising your tax can benefit you outside of business in these sort of areas. And this is just not limited to that as well. Next slide, please. Some common questions that I find when talking with clients in tax planning space is usually, is there any sort of difference around this year compared to last year for end of financial year? So we'll cover off on a couple of things today. What will you be looking out for when you're reviewing my numbers? Again, we'll talk about the process today on how we do that. How can I pay less tax? Again, we'll be touching on that. But some areas to be sort of aware of before we sort of get into it is your business a small entity? Marianne will be touching on that. And to be aware that the company tax rates are lower than normal individuals. So companies, if they're in business, pays tax at 25%. Next slide, please. So these are the things the two things that I'm sort of talking about with clients that a bit of a pro tip. Previously to this financial year, if you have purchased an asset, be it a car, for example, and you've fully written off that car in the prior financial year, and then you go and sell it this year, that's an actual income to your business, and potentially you may have to pay tax on the full consideration you've received for that car. So be mindful when you're actually selling assets this financial year or the next one, that there might be a taxing point because of what's occurred with the rules around instant asset write-off. So that's one thing. And the stage 3 tax cuts, which are in law now. So there'll be less tax to pay as an individual next financial year compared to this financial year. So that's something to be wary of. Next slide, please. And I'll hand it over to Marianne to run through some proactive tips, I think. Or is this me still, Marianne?
I think the proactive tips were yours, Stuart?
Yes, sorry, apologise.
Yeah.
This is for me. I was in such not a rushing mood, but I was smashing through those slides that I forgot about this slide, which is all good. So this is the methodology that we usually go through when we start to review or start to put together tax strategies for clients. And this is the methodology we go through. So the first thing we do is often we talk to clients about putting an estimate together for their taxable income. What I mean by that is how much income have you actually earned this financial year for your business as well as your personal. So we get an overall picture of your potential profit in your business as well as any sort of tax outcome for you personally. And what we can do there is put together an estimate if we do nothing for your potential tax liability for this financial year. So there's a methodology. So keeping your books up to date in relation to your business is really important. Without keeping your books up to date, we can't even start with this sort of thing because we'll be sort of guessing. So being proactive is probably keeping your books up to date. And then once we actually have an understanding of business profit as well as personal income, and we've put together a potential tax liability, is putting some strategies in place around reducing your family group's taxable income. We like to spread income and taxing points across the family group. So traditionally, we try to keep your taxing point for your group around the 30% mark and putting strategies in place. So we will, first of all, work out your profit, work out your tax, put together some strategies and advise our clients around potential strategies for the 2024 year. And we meet with our clients to sort of discuss this, because tax can be pretty complicated. And dealing with them this financial year compared to past after 30th of June is too late. So being proactive is really important. And that's me. So I'll move on to the next slide now. And now I'll successfully hand over to Marianne.
Yeah, so this one's mine. So essentially, we will be running through general items to consider before 30th of June 24. As Stuart mentioned before, an important term or thing that we usually get asked is, what is a small business entity? So this question is important because there are some tax concessions that a small business entity can apply. In order to be a small business entity, you firstly have to be carrying on the business. And secondly, your aggregated turnover is less than 10 million. And we will run through this together with the general items. So then first on the list is completing a stock take. So this is a requirement at year end to report the closing value of your stock. Completing a stock take also ensures that your records are accurate and correct. It can also identify low and high levels of stock, obsolete or worthless stock, and also it can identify any security issues such as theft. Now, if your business is a small business entity and your stock has changed by less than $5,000 from the start of the financial year to the end of the financial year, you can opt to apply what's called the simplified trading stock rules. This means that you do not need to complete a formal stock take, so you don't need to do a physical count. And you also do not need to account for changes in your stock's value. Next slide, please. So another item to consider is reviewing your debtor ledgers for bad debts. So if you are reporting on an accruals basis, this means that your receivables is included as part of your assessable income. Hence, it's important to review the debtors ledger for any unrecoverable amounts. Now, in order for it to be included as a tax deduction, you need to write off the debt to the P&L. But then what happens when later down the track you do recover the bad debt? So when this happens, the cash that you received, you would just report that as assessable in the income you receive it. So the next general item is paying your staff and also your superannuation prior to 30th of June 24. So for super to be deductible, the fund or the small business clearinghouse needs to receive the contribution before 30th of June 24. Hence, we recommend that you don't leave payment of super to the last minute. We recommend that you pay this well ahead of 30th of June 24. This is to allow for processing time or delays and to ensure that you do get the tax deduction this financial year. Now, the 24 concessional contributions cap is 27.5. In 25, this is increasing to 30,000. However, keep in mind that you may be able to contribute more because of the carried forward concessional cap. So say, for example, in 23, you contributed 17.5. You have that 10,000 to carry forward, and you can carry that forward for a maximum of 5 years. Next slide, please. Another item to consider is whether you have any prepayments. So for example, can you pay your July rent in June to get that tax deduction? Other expenses include interest, advertising or marketing, and insurance. Now, generally prepayments are deductible over the period it covers, or 10 years, whichever is lesser. However, there are some exemptions to this. Firstly, if the cost is less than $1,000, this excludes GST, you can immediately deduct. Also, if you are a small business entity and the period covers is 12 months or less, you can also immediately deduct the costs. So say if you pay your July to December rent, even though it's greater than $1,000, you will be able to deduct it if paid before 30th of June 24. Another item to consider is then, are there any expenses that can be brought forward? Were you planning on purchasing consumables, stationery, office supplies in July? So potentially, can you make the payment and purchase now to get the deduction this financial year? On the other hand, you also have income. Can any of these be delayed? This includes selling an investment. Now, with regards to selling an investment, the key date is the contract date. Sorry, there's a spelling error there. So contract date. So that determines when the sale occurs, so not the settlement date. And lastly on the list, we've got invoicing. If you are planning on invoicing in 30th of June, you may want to consider whether that can be delayed in July so that the assessable income will be in the next financial year. Next slide, please. And another general item to consider is whether you were planning on purchasing a new asset. So this could be a car, computer, laptop. One thing to note there though is depreciation only starts when it is installed and ready for use. So for example, with a car, if you put in an order before 30th of June, but it does not get delivered till months later, you won't actually be able to depreciate until you receive the motor vehicle. And for a small business entity, there are concessions. So firstly, the simplified depreciation rules that can be applied. The first is the instant asset write-off. Now, what the threshold is currently is 20,000, less excluding GST. However, note that this isn't law yet. So there's been a little bit of an update that they've put a proposal that it's now increasing to 30,000. And as part of the updates, before we previously mentioned that the aggregated turnover to be a small business entity needs to be less than 10 mil. For the purposes of the instant asset write-off, they are proposing to increase this to 50 million. And as part of the simplified depreciation rules, you can also opt to use the general small business pool. This means that the first year you get a 15% deduction, then the second year and the year after that, it will be at 30%. Next slide, please. And now we're looking at some specific expenses to consider before the end of financial year. Firstly, repairs and maintenance. So this is deductible when incurred, and it could be for your business, your employment, or rental property. You will need to just look out for genuine repairs versus capital improvements. So say if the cost is making the asset better, it's enhancing it, or it's adding value, increasing the value, then it's more likely to be a capital improvement. And an example of this would be renovations. Then with regards to your rental property, you may want to engage in a quantity surveyor for an investment property depreciation report. This will ensure that you can claim the maximum depreciation and building write-off. And the cost to engage in that quantity surveyor is also tax deductible. Next on the list is donations. So donations of $2 or more is deductible. However, the deduction or the gift needs to be given to a deductible gift recipient. So this means that the organisation is registered to receive gifts. So generally, crowdfunding campaigns are not deductible gift recipients. Also, raffle tickets are not tax deductible because you will be receiving a benefit in return. Then last on the list of specific expenses to consider is income protection. So the insurance needs to relate to your salary or wages, and it would generally replace 75% of your salary. But to have the income protection, it's also for peace of mind in case you're unable to work because of injury or sickness. And also to note that if the income protection insurance policy is under your superannuation fund, you cannot claim this as a tax deduction. You also cannot claim if it relates to life insurance, trauma insurance, and critical care insurance. Next slide, please. Great, so thank you. I think that was all the expenses and items to consider before 30th of June 24.
Thank you, Marianne. Yeah, really well done, Marianne. So even the smallest changes or smallest adjustments, as well as being proactive, can make a difference in terms of the relationship with your tax liability. So what I'm going to speak about now is getting your paperwork right. Yes, we all don't enjoy paperwork, but this is a vital information. These little bits and pieces is vital information that you need to finalise before 30th of June to keep the ATO happy, as well as plan for your tax returns, because we find a lot of cases in terms of ATO and ATO audit. The first question they'll ask for is, please provide any sort of paperwork to justify your decision, as well as justify your tax deduction. So if you don't have the proper paperwork in place, the ATO will automatically rule out any sort of claim or any sort of a decision that you've sort of made. So getting the paperwork right is really important. So here's a simple tax savings that we talk with our clients. If you're running a business or have an investment trust and your trust deed allows you to distribute to a company, what we talk about is establishing a corporate beneficiary so that you can distribute some of your profits to improve your tax position, depending on your depending on what your trust does. The corporate beneficiary will be taxed at 25% if it is a business, or 30% if it's investment trust. You'll often hear us call the corporate beneficiary a bucket company, as that is because all the company does is receive a trust distribution from the trust, so the business. It's not a final tax. When winding down the whole group structure, there will be a further taxing point for that distribution company in terms of getting profits out. So individually, they will end up paying eventually some tax, but there will be a reduced tax liability. But we talk about that with our clients in relationship to this. So we've got a couple of examples here. So assuming your trust earns $250,000 in profit, so that's not sales, that's profit from a business. Therefore, the corporate beneficiary will be taxed at 25%. In option one, if we distribute profits at 50-50 to an individual, 1 and 2, a tax liability, including Medicare levy, will be taxed at $67,000, so about 27% tax. In option 2, if you distribute 90% to each individual, so 1 and 2, and distribute the balance of $70,000 to a bucket company or a corporate beneficiary, the tax rate's at 25%. The total tax liability would be $60,000, so 24%. So there's some tax savings there to be had. This is assuming that the 70% in the cash is available to distribute to the bucket company. Otherwise, that is known as a Division 7A. Some sort of loan agreement would need to be put in place. So your tax affairs will be a little bit more complicated if putting this strategy in place. However, weighing that up between complication versus tax savings is something that needs to be considered. Next slide, please. The next thing to do for your trust is to prepare trust distribution minutes. We prepare these with our clients in discussion with our clients in the tax planning stage. So we're starting to have that conversations now. The trust distribution minute is how the profit of the trust, that could be income, that could be capital gains, it could be dividends, how it's going to be split to its different beneficiaries. So a trust doesn't pay tax, beneficiaries do. So how we do that is the first steps is we review your prior year trust distribution resolution to see what's occurred in the past. reviewing whether you can still allocate trust distributions to adult children or parents as a result of the new ATO rulings. So that's something to be considered. So that is different to this financial year. Without going into heavy detail, the ATO ruling, you need to ensure that these, so children or parents or adult parents, these beneficiaries are entitled to the distribution and not an avoidance of tax for your beneficiaries. Then we confirm with you of an estimated estimate trust income for your trust for the year 30th of June 2024, and preparing the tax planning calculations, which we've sort of touched on already. Then we review your trust deed to make sure that you're actually in line with your trust deed. So going back to the paperwork to make sure that you can actually do what we're planning to do, and putting together a trust distribution resolution for the 2024 year, just to make sure that distributions are going to the correct beneficiary. Then we advise on the most tax effective distribution, and then we prepare the resolution to make sure it's actually signed off prior to 30th of June. So that's a big underline there. Prior to 30th of June, it needs to be lined up because all trust distribution minutes need to be done before 30th of June. And it's important that you have a signed copy of this in our office. So taking to the next slide, so stepping away from trusts, some important areas to look at here is for companies. As part of tax planning, you'll be potentially maybe paying a dividend out of that company in the 2024 year. So dividend documentation is required. So calculating whether the dividend is going to be franked dividend or unfranked dividend, and actually having the documentation before 30th of June. So 30th of June is a Sunday this year, so just making sure that you have that director's minutes over a Sunday session and getting the paperwork done. As we quickly touched base earlier, Division 7A loan is when a shareholder or an associate takes money out of a company, or a trust distribution to a corporate beneficiary doesn't actually get paid within the year that it actually makes the money. As part of our tax planning, we make sure that Division 7A loans are compliant. So touching on that point, making sure that you are compliant and all the necessary ATO agreements are signed off on. So again, having the paperwork right. Making sure that payroll tax obligations, if you are registered for payroll tax, ensuring that all your obligations for monthly reporting are done, ensuring that the annual tax reconciliation is lodged on time, being the end of July. When reviewing your figures as part of your tax planning, we also check your wage figures and determine if you're actually meant to be relevant, registered for payroll tax. The last thing you want is actually a review from the State Revenue Office, depending on where you're trading. Single touch payroll, so that's what STP stands for, making sure that your obligations are met. So getting the paperwork right. A lot of computerized accounting packages sort the STP obligations for you, but making sure that you're actually lodging the required forms with the ATO through your software on time and to the ATO. Also bearing in mind that small business income tax offset, there is a maximum of $1,000 there. This is eligible for sole traders, income beneficiaries of trading trust or partnership. And again, the maximum you can get is $1,000 there. Thanks. Next slide. Some quick handy hints. Making sure that you actually have a logbook and it's up to date. We've had a few audits in the past where the ATO have disallowed motor vehicle claims because, first of all, there was no logbook, or the logbook wasn't done correctly. Another audit area that we're finding is making sure that you have the necessary documentation about working from home. As you can imagine, working from home claims jumped during the COVID time. But again, making sure that you've got the documentation to prove that you've actually done the working from home, and their rules have actually changed around that. The other one was determining space of your office. If you have a designated space where you work from at home, please ensure you measure the space and calculate the percentage of that space in your home. This way you can accurately deduct for your running costs of the space, and that's including heating and electricity. And we wrap this all up by saying anti-avoidance warning. Make sure that so all the completed things are on time. You're not sort of doing things for the wrong reasons. and being aware that the ATO can disallow things if you don't have the right stuff in place. Next slide, and I'm handing over to Mark.
Thanks, Stuart. You'd think by now with this that I'd unmute myself before I tried to start talking, but there we go. I'm covering areas of personal taxes. It does align with business taxes. All businesses have an owner, and so the owners take out their income from their business in a manner of different ways. So whilst some of this will talk to our individual clients, all our business owners are individuals as well. In relation to what we need to prepare before the 30th of June or after the 30th of June, we no longer have to issue PAYG statements or certificates. With single touch payroll now applies to all businesses. So within the STP scenario, at the end of the financial year, once we're happy with the wages for the year, we can lodge STP finalisation. One thing to note, if there is a mistake in this single touch payroll finalisation, we are, as your tax agent, we are able to go back to the ATO and update any changes, and that will flow through to the ATO portal, where it then matches back to your tax return. Next slide. As individuals, some of the things that we need to do before the end of the financial year. Dividends, usually publicly listed companies, the dividend information is shared with the ATO from the share registry if you've quoted your TFN. So if you haven't quoted your TFN, this automatic transfer doesn't happen, but also you'd be paying withholding tax as well. So that's important. If you do own shares, do quote your tax file number. It just makes the whole share ownership easier. Now, it does take a little time for these share registries to be updated. Usually the tax office advised by the end of September that the data needs to be with the share registry. So if you want your tax return prepared before the end of September, then you'll need to manually give us the dividend information. In relation to all investments, gather the purchase details and sale contracts. So if there's any sales during a financial year, we will have to do a capital gains tax calculation. Whether that's a profit or a loss, it still needs to be reported in the year. And the only way for us to do that is to have the original purchase information and the sale contract. And as Marianne mentioned earlier, a contract sale for capital gains tax purposes is when the asset's sold. So if you're selling a house and you've got a 60-day settlement and you sell it on the 1st of June, the contract's the 1st of June, and you don't settle till the 1st of August, then you actually declare that capital gain in the current financial year. Cryptocurrency is something that's been around for a little while now, but we are constantly coming up with issues. Cryptocurrency houses now report transactions to the ATO, so they're aware if you've traded. They're not aware whether you've made a profit or a loss, but they're aware of your trading. So we're starting to see this on the ATO automatic pre-fill. Simply selling a cryptocurrency is actually a income of some description, income or loss. So you might have sold one cryptocurrency to buy another cryptocurrency. You may not have put it into Aussie dollars or US dollars, but that simple transaction is actually a trade that needs to be reported to the ATO. And when we've looked at these transactions, sometimes people could be doing hundreds of transactions a year because they're selling a bit, buying a bit. They might be purchasing something with the cryptocurrency. So if you purchase something with the cryptocurrency, that possibly is a sale of the cryptocurrency as well. So we suggest that that our clients use a platform such as Coily. I'm not advertising their platform, but it helps summarize your trading transactions. So it means that you're not paying Rubiix hundreds or thousands of dollars to go through each transaction. There's a computer report at the end that tells you whether you've made profits or losses on each transaction and summarizes it at the end. It really is a time saver, both from your point of view as the investor and also as your tax agent. Next slide. Motor vehicle deductions. So we haven't really talked about that yet, but motor vehicle deductions as a business owner, you probably run a car through your business. You might also have employees that you provide a car for. So we've spoken already about ways to save tax. And one of the ways to save tax if you're using your motor vehicle for a fair bit with work is doing a valid logbook. A logbook is valid from 5 years. So if you fill in one this financial year, it is valid for the next 4 after that. If you have an expired logbook, you can actually start your logbook now. I know we don't have 12 weeks left of this financial year, but that 12 weeks can go between 2 financial years. It just needs to be completed for the 12-week period. We talk here a little bit about fringe benefits tax. So a motor vehicle is not automatically deductible to businesses. It's considered a fringe benefit. So that means that it's taxed differently from normal expenses. And what the fringe benefits relates to is the private use of the car. So you'll see that most of our clients, when they're in business, we do a private use calculation, and you might see an employee contribution for that. So what that means is you as the business owner, if it's your car, you put a contribution into the business to pay for your private use. So if we can get rid of that private use or reduce that private use by having a logbook, then that's a good outcome. Then you're not doing that contribution or you're not paying that tax on behalf of your employees. One of the things that recently has come out is that there is an exemption from FBT for low emission vehicles. Now, this is a personal thing. I picked up my first electric vehicle last week, so it's kind of close to my heart at the moment. So where in a vehicle is a low emissions vehicle, including 100% electric vehicles. They also talk about hybrids. Hybrids do not fall into this category because hybrids have petrol drives the low emissions, drives the electricity. But there are other cars that are also included in here. So if your car qualifies for the FBT exemption for low emissions, then you don't need to declare any private use. It's exempt from FBT. That means it's fully tax deductible to your business. Now, there is a price that the car needs to fall under. So it's described as the list price, which for the current year is $89,332. Now, what a list price of a car is, it's the price on the dealer before you add fees and charges. So before you add GST, and that level there, the $89,000, is actually the level of where luxury car tax starts. Now, for electric vehicles, luxury car tax starts higher because the government acknowledges that electric cars cost more to build because we've got things like expensive batteries in them. So if you can, if you are looking to have an exempt car, then this may be one avenue for you to follow, to buy an electric vehicle and its list price is less than $89,000. So it's very interesting. So other things that we can claim as individuals, they're not necessarily business related. If you have any personal expenses such as stationery that you don't put through the business, or other things up to $150, you can get tax deduction with no receipts. So the other things might be for laundry of those expenses of clothing. Now, to qualify for this deduction, it needs to be occupation-specific clothing. So my suit that I'm wearing today might be an expectation, but it's not. It's not occupation-specific. So an example of occupation-specific might be the coats that doctors wear, or the surgery clothes that theatre technicians wear, or it could be protective clothing, including goggles, sunglasses, could include boots for people who work in industry. Or it could be a compulsory uniform that you're required to purchase, such as if you work at, say, a supermarket, an airline, those sorts of things. So we are able to get a tax deduction when they are in these areas, and we're not required to keep a receipt if we spend less than $150. If we spend more than $150, then we are required to keep a receipt. In the protective clothing area, goggles and sunglasses. So sunglasses could be for someone who works outside. Now, it could be, for example, a personal trainer who does most of their training in a public park. Then sunglasses would be protective clothing in that particular industry. Goggles might be required if you work as a tradesman and you have dust and particles flying through the air. So next slide, thank you. Home office deductions. As Stuart said, the world's changed. People are working from home. As a business owner, you might be working from home from periods of time. There's been some changes in how we deduct home office. The shortcut method during COVID was quite generous. It was 80 cents an hour. The tax office has pared that back now to 67 cents per hour. And this covers your phone, internet, stationery, computer consumables, and gas and electric, so your heat and light for your home. So the 67 cents an hour, it needs to be done with a logbook. So we've mentioned previously keeping a log of you working from home. So that could be done electronically. It could be done in your diary, for example, that you block out days when you are working from home. So that shortcut method's based on hours by days for a shortcut method. The other way to deduct home office is the actual cost method, and to determine your actual expenses and apportion them based on work use. So that would mean that you would need to keep your phone invoices, your internet, your stationery, or your gas and electricity receipts, and then you would work out a percentage of use for business or for employment, and base that on your percentage use. Now, that can include, if you are renting your home or your home office, a percentage of the rent based on the room size and the rent, but it needs to be a dedicated office. So if you're working from the dining table of a rental property, then you're not able to claim the dining room as your office unless you take the dining table out and have a desk in there. Also, with the actual cost method, we can get a decline in value. So if you buy the chair, you buy the desk, you buy the computer for home, you can get depreciation. There is a $300 immediate write-off for items. So if the chair costs $299, then that's immediately deductible. Otherwise, it's based on the useful life. So next slide. We're at the end of the presentation, and it's time for you to ask all of us those questions you've been wanting to ask for the whole seminar. So do we have any questions? Madonna.
Fabulous presentation. Thanks, guys. Always wealth of information. Just wanting to know, is there any advantage to actually registering your vehicle in your company name? Or can you, can you claim more if it's actually registered in your company name as opposed to your personal name and you just do that logbook? What's the deal?
Yeah. So with running a vehicle in your personal name, you've got a couple of ways to claim it. You can claim a cents per kilometre based on the engine size, and you can claim up to 5,000 kilometres. So that you can claim as an individual. And the other way is to claim it via a logbook. So you have to claim it as a logbook. It's actually slightly easier to claim the vehicle in a company, and also you pick up the GST if you push it through your company or trust or whichever entity that you're trading through. So it is something probably to have a conversation with your Rubiix advisor just on that, but generally it's there are less rules around claiming a deduction from motor vehicle in a business than there are personally. Some of the exemptions may apply as well, and GST as in a personal name, unless you're a sole trader, you wouldn't be picking up the GST.
Cool, thank you.
Mr. Williams.
Stuart, thank you. Thank you, Mark and Anna-Marie, for a good presentation. Look, this may be an urban myth, but I had heard that there's a potential risk if you have a dedicated home office and you claim the total proportionate cost of that home office as a business expense, that when you come to sell your home, they might consider that space proportion of your home is no longer capital gains tax free. Do you know anything about that?
Yeah, you're correct. And that's why when I mentioned homes before, I mentioned rent. So it doesn't apply to rent, but it does apply to people who own their own home. So if you're conducting a business from your own home, then if it's, for example, you've got an office in the garage and people come and meet in that space, then potentially there could be a capital gains tax outcome, especially if you're trading as an individual. If you're trading as a company, then and you're not claiming any of the ownership costs, then there would be no capital gains tax implications. And it's the same with working from home as well. If you don't claim the ownership costs, if you're only claiming the occupancy costs, so like the heat, light, power, those sorts of costs, but the ownership costs like the rates, the interest you pay, we shouldn't be paying land tax, but if land tax was applicable on your home. So we strongly encourage clients not to claim their occupancy costs if they own their home.
Right. Okay. But as you said, the electricity, heating, etc. are fine.
Yeah.
Fine.
So
okay.
your occupancy costs.
Great. Okay. Thanks.
Thanks for your comment, Madonna. Any other questions today?
If we've got no further questions, we might go to the last slide. Last slide, if you want to follow us in the regular other types of the social media sphere, here is 4 options to really get more detail around some of these topics we covered today. We're pretty, not prolific, but we are updating a fair amount through these socials, and we've got some QR codes there to sort of scan as well. So please follow us along. And then the final slide, there we are. That's this. That's how you get in contact with us. Either knock on our door at 50 Queen Street or give us a call. I think that's it. Thank you so much everyone for coming along. And if you've got any questions specific to you, please don't hesitate in contacting us.
Thank you, everyone.
Thank you, everyone.
Thank